to sort of the great big Lehman crash, what has happened in the 10 years after, and what might happen next. And we do all of this in half an hour. So let's try. Well, for me, finance performs four main functions. The first is signaling. So financial markets are supposed to be markets for information, right? There is the price discovery mechanism. Every time a share or an asset is bought or sold, it creates a new data point that says, this is what this particular asset is worth. So financial markets, more than anything else, are markets for information, for price discovery, and that is a very important aspect. The second is, it's supposed to be to actually support the real economy, right? I mean, finance provides the resources to make investments. The financial system is supposed to take resources from there are too many savings, too few investment opportunities, and to redirect them to where the investment opportunities are greater, and there is a paucity of savings, right? So that's a second important function, support. The third important function is what we call stewardship, right? So once you've made the investment, you have sort of done the price discovery, the point is to oversee the investment. So if we look today, almost all large companies are owned by large institutional investors, not the least of which is our great big Norwegian sovereign wealth fund, which owns between 1 and 2% of most large listed companies in the world. So these investors then have a stewardship responsibility, right, to safeguard the investments that they make, which means they have to oversee how the agents they have given money to, company management and company boards in this instance, how are they managing the money? And if they're not, they're supposed to intervene if they're not managing it well, right? So that's the third main function. And the fourth, the sort of obvious one that we sort of forget to discuss, is that finance is supposed to do something useful for society. And that is because, unlike many other activities in the economy, finance is a privileged activity that depends to a much greater degree than most others on trust. And that requires a social license, right? So there is a reason that bankers, misquoting our great Norwegian playwright, were called pillars of society, because a banker's word used to mean something. And that's because they have this privileged position. So historically, when money was created, it was created mostly by the central banks. And of course, if you can create free money, there's a lot of privilege that comes with that. And that all used to go to the central bank. In the present financial system, almost all money is created in the private banking system. So that is, again, a great privilege that we give to those in the financial system. And that is a social license. And that social license means there are obligations that come with it, which is you really should be doing something useful for society, or at the very least, please don't do something that is harmful for society, right? So that is the background context, the four main functions of finance: signaling, support, stewardship, and society, the four S's, okay? So how are we doing based on those benchmarks? The answer is not very good. Let's look at all four in turn. If you look at the number of transactions happening in stock markets today, depending on which one you look at, let's look at New York Stock Exchange. More than half of them are done by algorithmic traders, by machine traders, by computers, okay? So that means these machines have no idea whether they're buying or selling Microsoft or Apple or Google. They just see a data point, some news flow, and based on that last data point, they react, right? So they are sort of indifferent to what sector, what company is it. They just see a flow of data, news, what was the last price, how has the price moved, and that's it, right? So it's not fundamentally contributing to what one thinks of traditionally as to discover whether a company is making sound investments or not. You know, you plow through its balance sheet, you look at the numbers, you try and see, is this an area where market demand is going to rise? Is this risky? Is this sensible? Isn't? None of that analytical element comes in, right? So it's a traditional sort of technical analysis. The next trade is based on the last trade, and that's it. The rest of the transactions are mostly done by the likes of Norwegian Sovereign Wealth Fund, which is mostly passive index investors that are just buying or selling the index. And a lot of it is automatic rebalancing. So less than 5% of transactions today in most stock exchanges are meaningful transactions of the kind that we would traditionally think, where you have put in some effort, you've done some analysis, and you say, okay, this is overpriced, I should sell. This is underpriced, I should buy. This is how price discovery was supposed to work. So this means that the price discovery mechanism, which is a very important signaling role of finance, doesn't really function well at all today. Most of the signals being sent by the stock markets are spurious. They have very little to do with whether this is a good use of capital or a bad use of capital. So that is broken. Let's come to the second idea of support. Much more money in most stock exchanges, the large developed markets, has gone towards leverage buyouts and to buybacks of shares, mostly to artificially increase the price of shares, so the management, which has had huge stock options, can benefit substantially from this artificial boost to share prices. Far less money, particularly over the past 10 to 20 years, has gone into IPOs, new companies coming in, raising capital to explore a new growth area, such as sustainable investing or artificial intelligence. Money is mostly being thrown at companies that don't need your money. Between Google, Apple, Amazon, and the like, they have about $1 trillion of cash lying offshore that hasn't been properly taxed. They don't need their money, and yet they are the ones mobilizing sort of the highest levels of debt to be able to do the tax arbitrage, benefit from very low borrowing costs, and it's financial capital. It's not really going into the real economy. The companies that actually need your money, the startup ventures, the new ideas, the solar power plants in Africa and India are not getting enough capital. At a systematic level, there is more money flowing out of emerging economies, frontier economies, and developing countries where there are rising populations, there are huge gains for productivity to be had, right? Because they're so far from the technological frontier, where there are new business models to be explored, where even basic infrastructure, even today in India, about a third of the population doesn't have access to electricity. All of this requires capital, and it's not free capital. They are not asking for charity. These are genuine investment opportunities that can deliver long-term returns and higher profitability than what you would get investing in a mature economy like Norway. But there is more money coming out of there, right? So even the support function of finance, where finance is supposed to push money from where there is too much, where the investment opportunities are drying up, to where there is too little, where the real investment and growth opportunities are, even on that function, finance is failing at an aggregate level. And the last idea of society, is finance functioning in a way that is useful to society? I think the aggregate answer to that is clear. With the rise of populism, with the rise of inequality, with significantly more money going into fossil fuels than money going into sustainability solutions, with more money being rewarded in the form of rises in share prices, if there is a leverage buyout that leads to the loss of jobs, than money going in where new jobs are created, the answer is, I am not so sure that we are actually at an aggregate level, the financial system being a very useful social function. So this brings us to step 2. Is finance somehow different and special to other sectors in the economy? Why should we be talking specifically about finance? The answer is absolutely yes. Let me give you a few examples. So, as students, you buy coffee, right? There is an increase in the price of coffee. Generally, on most real economy transactions and goods, your response would be to reduce your demand, right? I mean, that is how the economy works. If something is expensive, you will generally buy less of it. If something is cheap, you will generally buy more of it. In finance, in financial assets in particular, this self-equilibrating mechanism breaks down. House prices in Norway, in Oslo, are going up. The first year you say, oh, okay, well, house prices have risen by 10%. Yeah, I'm not so sure. I don't think I can afford it, right? Next year they rise by 10% more. And you find out that the neighbor next to you who bought it 2 years back is suddenly 50,000 Norwegian kroner richer. And you're like, okay, year three, that goes up again, and you start feeling like you're really, really missing out, right? And this person is like, look, I made such a smart decision. I've got a nice house. I've got fantastic furniture. Hey, and I got money in the bank. I'm going to go on a holiday. Eventually, this catches up with you, this FOMO, fear of missing out, and you get into the market too. Financial assets work this way. The price of a financial asset, be it the share price of Google or Apple, or house prices in Oslo go up, demand fairly often actually goes up. And this makes it reinforcing. This is one of the reasons that financial cycle is so extreme. Rising financial prices lead to behavior that makes them rise further. Number two, if you look at clothing stores on the high street, let's just look at one of the shopping centers, maybe in Oslo S, right? There's an H&M, there's a Benetton, there's 3 or 4 of them. If one of them goes out of business, it's good for the other stores, right? If one of the shoe stores in a heavily concentrated market goes out of business, it's good for the other shoe stores. This is not how it works for finance. If there are 2 or 3 banks in the high street, right? Let's say Nordea, Danske, DNB, and one of them goes out of business, it's very bad for the others. Number one, because finance, as we discussed, is mostly based on trust, much more so than other sectors of the economy. If one of them fails, and you've all seen the headlines around Danske Bank and the $200 billion of money laundering, the first question we ask ourselves is, could DNB be doing the same? Maybe Nordea is also doing the same, right? Similarly, when Lehman crashed, the first question everybody rightly asked themselves was, who's going to be next? The reason behind this is the disproportionate role of trust. The second reason is most clothing stores, if there's H&M and Benetton in the same shopping complex, they don't have any business with each other. If there's Danske, DNB, and Nordea, all of them have much more business with each other in the form of interbank lending than they do with you customers, right? So within the financial system, the interfinancial institutions transactions, no matter how you look at it, are significantly greater than the transactions the financial system has with the real economy. What it means is, if your counterparty fails, right? So if I'm DNB and I have big dealings with Danske, and if Danske fails, I am possibly also going to fail. So there is a good reason why any sort of failure in the financial system has a huge repercussion on the rest of the financial system. And it's actually bad for business, right? Number three, the way it is different is, think you are buying a TV or a refrigerator. You bring it home. First of all, you get to sort of touch it and feel it in the shop, right? Then you bring it home. And in most cases, consumer protection legislation today says if you don't like it, you can give it back within 24 hours or even 30 days, right? You can even do it with clothing from H&M. But you buy a pension product. You buy an insurance policy. The first time you find out the insurance policy you bought does not work is when your house has already burned down. The first time you realize that the pension that you've been saving for has not been appropriately invested is when it's too late, right? I mean, you've spent 20 years saving and it's just too late to do anything about it. So finance, on a number, if I could go on and on, but on a number of fundamental ways, finance is different from the rest of the economy and hence needs far stronger oversight, right? With me so far? Excellent. We continue. The next important question to ask is, the financial system, sort of insists, if you look at any of the chief economists of the large banks, they're always asking everybody to be much more competitive, right? Much more productive, much more efficient. Let's look at the financial sector as a whole. So if you are in planet Mars and you're looking down on Earth and somebody tells you we have a very well functioning, efficient financial sector, and you look at it, what do you expect? You expect it to be cheap, right? The financial sector, like human resources or accounting, doesn't actually produce the chairs that you can sit on or the food you eat. It is a support sector. It's not a sector in itself. It supports the rest of the economy, things that are actually useful to human beings and our survival. That means that, like human resources and accounting, they're important, but they usually should have an office in the basement. It's exactly the opposite. At the peak of the US financial cycle, before Lehman crash, the financial sector was generating 40% of all corporate profits in the United States, right? I mean, look at it from Mars. If this is supposed to be an efficient sector, you want it to be no nonsense, a bit boring and efficient. Imagine a company, unless it's a human resources agency, imagine a company, Google or something, where human resources was consuming or accounting was generating 40% of profits. There is something wrong with that system. And that is something that we need to remember, right? So it was very dysfunctional. It was definitely not efficient. Was it effective? On many of these parameters that I started with about support, whether finance was delivering money to where it was needed and could be actually effectively deployed, by most measures, no, it wasn't actually very effective either, right? Was it competitive? So in theory, yes. In reality, no. I remember a conversation with the then CEO of HSBC in 2006 who had just gone and complained very loudly about how high the cost of regulation was. And I think I remember the figure, it was something like $700 million worth of compliance costs every year that HSBC had to pay. But off the record, when we were discussing, he said, it's the best thing we have. Imagine which other institution in the world can afford to pay $700 million in compliance costs. If in particular now, with all the new regulation that came in after the crisis, you're trying to set up a bank, you're trying to enter the Norwegian market, the compliance cost is so high that it is a huge, significant barrier to entry. The financial system is really not competitive, right? So most of these measures that are supposed to tell you whether a sector of the economy is functioning well or not, the answer is the financial system really is not. So by even its own expectations, what it wants other sectors to do, the financial system is failing. One way of thinking about, the longer term trend, what happened with the crisis, is think of finance sort of as a traffic system. So a traffic system, what it does is it delivers people and goods from point A to B, hopefully efficiently, right? You don't want to take till tomorrow to get there, but you want to be safe. So without too many crashes on the way, without too much fuss. So the old-fashioned, highly regulated, boring financial system of the 60s and the 70s, you can think of the individual banks as cars, right? So there were cars driving down the road. The speed limit was relatively low, not very high, and the drivers were sort of fairly responsible. And if they were not, there were a lot of traffic policemen on the way. There were traffic cameras. There were a lot of speed bumps. So there was not that much you could do that was crazy and risky. And it was functioning, relatively well in some obscurity. I mean, bankers were, for many decades, supposed to be boring, and they were. I mean, they still are, but they make our life more risky, if interesting. So that slowly changed, right? So that slowly changed because the cars slowly became pickup trucks. The pickup trucks became 16-wheelers. So banks started consolidating and growing in size and internationalizing to the point where just before Lehman crashed, we had a number of giants. We had JP Morgan, Lehman itself was a giant. We had HSBC, we had Barclays, and so on and so forth, right? I mean, we had these huge banks. So think of these as big trucks. What these trucks did was then they started exotic products, transporting exotic products. So you've seen these chemical trucks that says Hazchem, or trucks with which are transporting petroleum, right? I mean, they're dangerous. Whenever I'm on the road and I pass by one of them, I try to keep my distance for good reason. and Warren Buffett called derivatives toxic products. It's a good metaphor. It's not strictly accurate. Some are not. But I think the point he made is important. A lot of these cars became big trucks, and the trucks became fuel tankers and hazardous chemical carriers, having more and more exotic products that were poorly understood and risky. And then we think of the drivers, these supposed boring bankers. They were incentivized as the culture, particularly starting in the 80s, of stock options permeated throughout the corporate landscape. They were incentivized to drive faster and faster because the bonuses on offer were 5 to 10 times the base salary. So if you arrived a fraction of a second earlier than your competitor, you were potentially going to get 5 times the compensation you would get if you arrived second. So there was a strong incentive to race. Then you add to that certain incentives, including, the competitive human nature, particularly on trading floors, and these drivers started snorting cocaine. At the same time all of this was happening, a lot of the regulators were reached out to. Hey, I know you're about to retire from the SEC. Your Fed term is coming to an end. Wouldn't be interesting if you came and worked at our bank, and we can compensate you well. The revolving door started, and particularly for public servants and regulators who had boring, relatively unexciting jobs, this revolving door was particularly attractive. So this is equivalent of the policeman being bribed or being told, hey, once you stop being a traffic cop, you can become a driver, and you want to keep that door open. The traffic cameras were spray painted over as banks started doing more and public exchange, as they started using offshore tax havens for regulatory and tax arbitrage. It became next to impossible for regulators to find out what these financial institutions were actually doing. And many of the speed bumps that were there, for example, the Volcker rule, for example, the fact that US investment banks and commercial banks were separated, that separation was taken away with this new world of finance where everybody was excited about how exciting finance was becoming, right? So think of this visual metaphor again. The boring, slow cars going with strict speed limits, with strong traffic cops, and with a lot of traffic cameras were replaced by careening tankers full of hazardous chemicals being driven by crazy cocaine-filled drivers, even as the spray paint meant that regulators couldn't see the chase that was going on. And to all of this, add a San Francisco fog descending. This is what happened. So when the first tanker crashed, which was Lehman, everybody was like, oh my God, what is going to happen next? Because nobody knew the details of what was on Lehman's balance sheet. And the only safe assumption was that Morgan Stanley would be next, that Goldman might come next. And under that circumstance, if you're a responsible driver like you and I, if you're a car, if you're operating a relatively safe bank somewhere, the best thing is to just stay at home and not drive. And this is exactly what happened. What led to the financial crisis was not Lehman's collapse. Most people don't know this, but Lehman's collapse actually only resulted in a few tens of billions of losses in a world economy that is close to about $100 trillion, right? So from a world economy perspective, it was peanuts, next to nothing. But what Lehman's collapse did, given the circumstance of opacity, was that it made everybody reassess what they were doing with their money, what they were doing with their savings, what they were doing with their spending. And it was that reaction to Lehman's collapse that led to the freezing up of the global economy. And that amplified the losses, etc. Right? So it's very important to get that context right. So that was what led to the financial crisis. The question then is, what was done about it? And what were the lessons learned? So if you stick to this analogy, a lesson would be maybe we should remove some of the hazardous chemicals. So that has partly happened. A lot of the over-the-counter derivatives that were non-transparent are now listed on exchanges and are treated in something called central clearing counterparties. So the regulators know what's going on. The non-transparent market is still there, but it's much smaller. What was supposed to happen was that the big trucks, because these financial institutions that were so big, present in so many countries, that if something went wrong, the effects would be global. Many of them, like the large Swiss banks, the large British banks, had balance sheets that were multiples of the GDP of the home country, right? So it can put a failure of one single bank can put a whole country's future at risk. So the idea was that they should really be shrunk. That has not happened. Instead, because of the financial crisis and the new reforms passed, there has been a huge consolidation in the banking sector. So the banks today, the concentration and size of banks in the US, in the UK, in Germany, in the rest of the EU is significantly higher today than it was before. So some of the toxicity, some of the dangerous products they were carrying has been reduced, but their size itself is bigger. What about the incentives? Are they still snorting cocaine? More so in the US than in the EU. So when we were working on EU financial legislation, we managed to reduce the rewards of potentially irresponsible behavior to just twice the base salary. So there's an EU law that limits bonuses to no more than twice the base salary. I wrote that, makes me very unpopular, but it has been breached occasionally, and things are going back as the lessons of the past 10 years are forgotten. The kind of irresponsible incentives are going back. The next thing you would want to do is to avoid the San Francisco fog, right? So general reduction in opacity, to have a more transparent regime. Some of that is happening, maybe not quite enough. The bigger lesson is, if you look at a traffic system, so it used to be when you had Lada in Russia, you had Ford's initial vehicles. Most of the accidents involved the failure of a brake or a car that exploded, right? That doesn't happen mostly anymore. Most of the dangers on the road come from collisions. It comes not from an exploding tire or a car suddenly stopping in the middle of the road, right? So you need a systemic view of the financial system. And that lesson has been learned partly. So there is a lot more monitoring of the financial system going on, because what matters is how institutions react, who is selling the product, who is buying it, who has, as we discussed, if one bank fails, it has big financial relations with others, it has huge consequences in others. And to be able to see what those relations are is hugely important. So some of that has happened. If you also remember, one of the things we spoke about was that if the price of an financial asset goes up, often the demand for it goes up, right? This makes the financial system very cyclical. So one of the other lessons learned was, what can you do to reduce the magnitude of this cycle? What can you do to dampen those incentives? There's something in place called the counter-cyclical capital buffers. It's a technical term for a very simple idea that when there is a boom, you increase the capital that banks are supposed to hold. You increase the amount of reserves they have to prepare for rainy days, which will eventually come. This is no different to what ants do in the summer when they stock up on food, and in the winter they have food, right? It's a commonsensical idea. The idea is the size of the financial cycle is so big that in order to compensate for this natural human instinct to get excited about rising asset prices and becoming more wealthy, the size of the capital you would need to hold would be very high. So the capital to be held in good times should be 4 or 5 times the capital that you need in bad times. That is not happening. We're only talking about marginal increases, right? So the lesson has been learned, but not quite enough. So this is where we are today. Some of the lessons have been learned, not quite enough. So the question now is, where is the financial system today, and what is likely to happen? So there, there will be an exponential crisis. The only question is, and the most important question is, where will it come from? The answer is, I don't know. And if I did, I'd be trading. I wouldn't be standing here in front of you. But there will be the next inevitable financial crisis. And the signs are everywhere. The first sign is many of the economies that did relatively well after the first financial crisis, Norway, Sweden, Canada, Australia, etc. The expectation here has been that we will continue to do well. Hey, look how well we handled 2009. And that has led to a significant amount of complacence. House prices didn't really adjust. The last big crisis we had was in 1991, which is more than many of us have been alive. It's the parents' generation or even the grandparents' generation. And those lessons have been forgotten. And you see the evidence in the asset prices. So maybe the next crisis or shock will come from one of these. I'm not sure. It's an idea. So that's number one. Number two, in response to the last crisis, we pumped in record amounts of assets, of government money into the financial system to stop the worst effects on the economy. It was sensible policy, but what it has done is it has put a lot of cheap money into a financial system where the supply of assets was limited. And when you try and buy with more and more new money, assets which are limited in supply, what happens? The price goes up. This explains almost 80% of the boom in stock prices and asset prices and house prices that we've seen in the past 10 years. Only about 20% of it is down to some fundamental measures of higher productivity or increased future potential growth. About 80% of it can be explained simply by this imbalance between supply and demand, right? So all of this new money has been put in. Now this new money is slowly being taken out as the US Fed starts increasing interest rates, as some of the quantitative easing, the roughly, I think, 10 to 15 trillion dollars that central banks bought of financial assets is starting to either, they are not, when the asset runs out, when the bond runs out, they are not replacing that, or some of them might even consider selling them back into the market. So that new money will slowly start tapering off. And what happens when the demand starts to fall for an asset? Its price falls. And we will start to see an adjustment of these asset prices. What will this do? The next crisis is more likely, I think, to come from the non-banking system. It's a guess, rather than the banking system. And as happens after every crisis, whatever led to that particular crisis, everybody is sort of paranoid about that. We have to make sure this doesn't happen again. But no two financial crises are exactly identical. The next financial or economic shock is likely to be different. And because we are looking so much at the banks, it's probably going to come from outside the banking system. If you look today at insurance firms, at pension funds, etc., and if you look at where they have got their money from, so there's roughly $80 trillion worth of money in pension funds, insurance firms, and general sort of asset managers, so-called sort of long-term investors, right? If you look at where they have got this 80 trillion from, less than half has actually come from new money coming in. So less than half of it has come from insurance premiums or pension payments that you make or your job makes, or new money coming in from the sale of oil into the Norwegian Sovereign Wealth Fund, for example, right? More than half has come from financial market returns, accumulated financial market returns. Now that is down to 4 factors, none of which will ever happen again. Okay. The first factor is, since the 1980s, there has been a secular fall in interest rates in the developed world. In the 1980s, US 10-year treasuries, US interest rates used to be about 8%. Since then, they have fallen to about 2%. They fell to about 1, then about 2. And this traces across Norway, across Sweden, and everywhere else in the rich world, right? So the price of money today is much lower than it was in the 1980s, which means if interest rates are lower, your house prices are higher and stock prices are higher. So that is the single biggest explanation for why there has been such a great performance by your pension funds, the Norwegian Sovereign Wealth Fund, and others. Number 2, China's arrival into the global economy. When China came into the global economy, it significantly changed the relative balance of capital versus labor. China with it brought 600 to 800 million new workers slowly integrated in the global economy. And that meant the share of profits going to labor versus capital shrunk dramatically. That meant the share of profits going to capital increased dramatically. And that meant that the share prices of the companies increased dramatically. India is not China. India is arriving into the global economy much later, particularly at a time that technology has already advanced, and there are other countries even poorer than India, which will do the textiles and all the other manufacturing that China took over. So India will have nothing like the kind of impact in the global economy that China did, right? So that won't be repeated. Number 3, corporate taxes used to be significantly higher in the 80s. Since then, there has been an occasional rise here and there, but for the most part, corporate taxes have fallen by between 10 to 30% across the rich world, right? What it means is, because what it matters to you as a shareholder is post-tax profit. Post-tax profit was bumped up, hence share prices were significantly bumped up. And number 4, there has been a great big effect over the long term of the new IT technological revolution. And some of that has led to a significant rise in profitability, particularly if you look at the US stock market and the percentage of profitability coming from the likes of Google, Apple, etc. It's unlikely that that will be repeated, and particularly that will be repeated without negative impact on other firms, right? So on all 4 of these factors, they are almost surely not going to be repeated. And some of them, such as the interest rates fall, are likely to now slowly go into reverse as interest rate normalization starts. So if anything, it is far more likely that asset prices are going to fall because of these structural trends. And there has been a response to populism outside of the US, where tax rates have fallen even further with Trump, unsustainably. In most other countries, people are actually starting to think about raising corporate tax rates again, partly to address the very high levels of inequality there is, right? So if anything, so more than one of these factors might go into reverse. So it's very likely that all the assumptions that have been made to pay out your pensions, to pay out your insurance policies, those may not hold true. And I think that is potentially the biggest single problem in the financial system today. So I don't know what the trigger will be, but there will be a recession, there will be a crisis, and this time round, this is going to be the structural huge deficit in our long-term savings is going to be the single biggest problem we will have to deal with, and there isn't an easy solution. Which brings us back to what I think the 4 biggest risks are to the financial system today. So again, I don't know what the trigger will be, how and when it will happen, but it's likely it'll happen soon. So if you compare ourselves to when Lehman crashed in 2008, we are significantly worse prepared to respond to the next financial shock. And let me tell you why. Number 1, as of today, we have much less fiscal policy space than we did in 2008, right? So a normal Keynesian reaction is, if there's a recession, the government starts spending more. Norway has money, Italy doesn't. Greece doesn't. The US deficit has gone from $161 billion to 800 some billion dollars. On average, within the rich countries, governments today have a debt to GDP ratio that is 30 to 40% higher than it was in 2008, right? So your ability to respond with government spending to the next recession or financial shock is much more diminished today than it was in 2008. The second biggest thing that happened was after each of the last three big recessions, the US Federal Reserve, the US Central Bank, cut interest rates by about 500 basis points, by about 5 percentage points, right? Just before the last recession hit, if you look at the Bank of England, the US Fed, the European Central Bank, etc., the average interest rates was about 4 or 5%. And they were able to cut it to zero. And in the case of Norway, Switzerland, and Sweden, even less than zero, right? What happens if there is a shock next month? How much can the Norwegian Central Bank, how much can the US Fed, how much can the ECB cut interest rates? You may still be able to go to -1%, but you can't go to -5, right? So there is much less room today. And this is even before we have started unwinding all of our quantitative easing, right? So there's still about 10 to 15 trillion worth of assets that are on central bank balance sheets. Yes, they could expand it further, but not without significant negative side effects of the kind we have seen, which include rise in asset price bubbles, rise in financial instability, rise in inequality. So much less monetary policy space. But the two biggest dangers are not the fiscal and monetary ones, but that is the lack of political space. So partly because we screwed up in the run-up to Lehman's crash and failed to properly oversee and regulate the financial sector, and partly because we screwed up in our response to the crisis, where we prioritized saving banks over saving people. So only Lehman was allowed to fail in the US. Almost 10 million Americans lost their homes. Far more money was pumped into saving AIG, Lehman, Bear Stearns, and others than was allocated to helping individuals. If you look at Spain, the number of individuals who lost their jobs and employment, who continue to have lifelong mortgages they can almost never repay, because like Norway, Spain has a recourse system. So just because your house falls in value doesn't mean that you can walk away from the loan. In the US, you can. And this has this combined with the fact that only two, I think, bankers actually went to jail, that many of the large bonuses, the average payout in the top investment banks in last year was more than $20 million. The large payouts are back. Nobody was held to account. Governments prioritized saving banks over helping individuals. And because of the asset price inflation, which came about because the central banks had to pump money in quantitative easing, it has meant that those who owned assets, for example, houses in Norway, versus those who didn't, the levels of inequality have gone up significantly. All of this is together with longer term trends of stagnating median wages for blue-collar workers have fueled the populism that we see. And this has led to significantly diminished political space in the center. If you look across the EU today, and I'm not even adding Trump to this, right? He's a category unto himself. But if you look at the EU today, on average, the share of left and right populists in government, in polls, is 20 to 30% higher today than it was 10 years back, which means, and you only have to look at Sweden, you see how hard it is to make a centrist government. And a centrist government is necessary to be able to sensibly respond to the next financial shock, right? Whatever you think of FRP or Sweden Democrats, the Danish People's Party, you wouldn't want them to be in charge when the next financial shock hits. You may agree or disagree with their policies on immigration, but they don't have fully formed policies on financial sector regulation, on taxation, on inequality, on mortgages and housing finance, right? That is sort of the very definition of populists. You see what's happening with Italy, where the populists are in government. And it is far less political space today in countries to react to the next financial shock or recession if you look internationally, and that is my last point, one great saving grace, no matter what you think of Gordon Brown personally or his personality or lack of charisma, he played, and I was there, a very important role in 2009 at the G20 by being able to convince the G20 leaders to have some form of a coordinated response, fiscal, counter-cyclical response, pumping in money, having coordination across bank rescues, etc. That helped the financial recovery to a significant extent. The US is now running an empty chair policy, more or less, at the G20 and G7. Trump, rather than solving international problems, is creating them. There's a trade war, not to mention the other potential conflicts he's unleashing. What can you expect of the G20 or the G7 in a coordinated, good faith response when the next crisis hits? And I think the answer has to be much less than what they were able to do in 2009. So I leave you with this sobering thought. Finance is fundamentally different. It's a very important part of the economy, but it is different from the rest, which is why, because it operates with this social license, because it has huge potential negative externalities when things go wrong, because it is cyclical, it needs to be watched more closely than other sectors based on its own criteria of efficiency and competitiveness and effectiveness. Finance fails at an aggregate level. We learned some appropriate lessons from the last crisis, but not enough of them. And in case you haven't noticed, it's important to keep reminding ourselves there was nothing special about Lehman, right? Enron, its failure was different. Enron was doing things that was criminal. There was no criminality in Lehman. By all measures, Lehman was no better or worse than Goldman or Morgan Stanley. It's purely an accident of history that Lehman happened first and Lehman died that others could live. Anytime you see a Goldman banker or Morgan Stanley coming and talking about how great they were or how great JP Morgan was, it is purely an accident of history that the crisis hit Lehman first, which meant all the others were rescued, which huge taxpayer expense for which nobody was held to account, right? So many of those lessons were learned, but not quite enough of them, which has led to a situation where the world today has $70 trillion of more debt than it did in 2008. That's about 25% more than it did, where the riskiness of the financial system is much greater today than it was back then. Only 11 countries and 2 companies in the United States, only 2 companies, now have a AAA rating. There is the average level of credit risk in the global bond market is significantly higher. This time around, the asset prices are at a peak. There is much more to fall. The next shock will come. I don't know from where. And this time, I'm a lifelong atheist, but may God be with us. I don't know what will happen next. Thank you. And I'd love to take questions.